Chapter 4, U.S. Government and Agency Debt. Video 1, U.S. Government Securities. In this video, we'll discuss marketable government securities including Treasury bills, Treasury notes, Treasury bonds, Treasury strips, Treasury inflation-protected securities, and cash management bills. We'll also discuss the risks of government securities and accrued interest. Treasury bills, also called T-bills, are short-term U.S. government debt that matures in 1 year or less. They're issued at a discount and mature at par, so there's no stated coupon. The difference between the purchase price and par at maturity is the interest income. The minimum denomination is $100, but for test purposes, always assume a par value of $1,000. T-bills are quoted on a discounted yield basis. The bid and ask prices of a T-bill may appear backwards, with the bid number being higher than the ask. A higher yield represents a lower price. T-notes are intermediate-term debt instruments. Notes have initial maturities of 2 to 10 years. T-bonds are long-term debt instruments with initial maturities greater than 10 years. Just like T-bills, both bonds and notes can be issued in minimum denominations of $100, but again, always assume a par value of $1,000. Notes and bonds are quoted in points and 30 seconds of a point. In our example, we have a quote of 105.16. The period is used to separate full points to the left, 105 points, and on the right side of the period is the 30 seconds of a point, so 16 over 32, 16 30 seconds. 1 point equals $10, so to convert this quote to a dollar price, multiply by $10 for a price of $1,055. T-strips are long-term treasuries that have been stripped of interest coupons. They are zero-coupon treasury obligations sold by the U.S. government. Here, strips stands for Separate Trading of Registered Interest and Principal Securities. T-strips earn imputed interest that is taxable in the year during which it's added to the investor's cost basis. This creates an annual tax liability. With that in mind, these work very well as retirement investments since they give a fixed rate of return and the income in retirement vehicles is tax-deferred. Treasury receipts are essentially the same as T-strips, except for two key differences. T-receipts were created and issued by broker-dealers, and they are not a direct obligation of the U.S. government. These receipts are backed by the interest and principal of Treasury securities that are owned by the broker-dealer and held in escrow. Treasury inflation-protected securities, or TIPS, have a $1,000 par value and pay interest semi-annually. The difference between long-term treasuries and TIPS is that with TIPS, the principal amount is adjusted every 6 months. The principal amount is adjusted based on changes in the Consumer Price Index. The interest rate is fixed. The fixed interest rate multiplied by the adjusted principal amount is received as an interest payment. Because of the principal adjustment, TIPS have no inflation risk, also known as purchasing power risk. At maturity, the investor gets the higher principal. If at maturity the principal amount has been lowered below par, the investor still receives the par value of $1,000. TIPS are suitable for investors that wish to avoid purchasing power risk. However, because of this protection, they're issued at a lower interest rate than other treasuries. Cash management bills, or CMBs, are very short-term debt securities that mature in days. These are sold on an as-needed basis to help the Treasury with cash flow needs. They're issued at a discount from par. The minimum increments are $100, and they have a slightly higher interest rate than equivalent maturity T-bills. While U.S. government securities have virtually no default risk, Most of them have both purchasing power risk and interest rate risk, with the exception being TIPS. Inflation means money will buy less in the future than it does now. Therefore, fixed income investors are the most vulnerable to purchasing power risk. Interest rate risk is the risk that an investment's value will change inversely to changes in the general economy's interest rates. This is the inverse relationship between interest rates and prices that we see with most fixed income securities. Duration measures price volatility. Duration is defined as the weighted average term to maturity of a security's cash flows. Translated into plain English, duration is the length of time it takes for the price of the bond to be repaid by its internal cash flows. The longer the maturity, the greater the duration, and the lower the coupon, the greater the duration. Bonds with the biggest duration numbers are those with long maturities and low coupons. These are the most volatile bonds. Long-term zero coupon bonds have the greatest durations and are the most volatile. Bonds with the lowest duration numbers are those with short maturities and high coupons. These are the least volatile bonds. Let's look at a few examples with side-by-side comparisons of different bonds. In our first example, when we compare two bonds with the same coupon, we see the bond with the longer maturity has the higher duration. A small change in interest rates may not result in much of a change in price for a short-term bond, but for a long-term bond, the change is magnified due to the number of years until maturity. In this example, let's assume interest rates rise by just 0.5% or 50 basis points. This causes the price of the 5-year bond to fall by 2.4%. Compare that to the 20-year bond, which sees a 6.1% drop in price. The longer maturity bond moves faster in price as the market interest rates move. In the second example, we compare bonds with the same maturities but different coupons. The lower the coupon, the higher the duration. The zero coupon bond has the highest duration at 5.0. If interest rates rise by 0.5%, the price of the zero coupon bond drops by 2.5%. Compare this to the 9% coupon bond, which will have a 2.09% decline in price. The lower coupon bond moves faster in price as market interest rates move. U.S. government issues traded in the secondary market may include accrued interest. Treasury issues accrue interest on actual day, month, year basis. Regular way settlement is T+1. And remember, interest accrues up to, but not including settlement. Let's look at an example. A customer buys a 10% $1,000 par government bond at 90 in a regular way trade. The trade date is Monday, March 3rd. The bond pays interest on January 1st and July 1st, meaning it's a J&J bond. Now we want to answer these two questions. First, how many days of accrued interest are due to the seller? And second, how much accrued interest will be paid? Remember, it's not a leap year. Step 1, figure out the settlement date. Regular way settlement is T+1, so one day after the trade date of March 3rd is Tuesday, March 4th. Step 2, identify the last interest payment. That would be January 1st. So 31 days in January, 28 days in February, and only 3 days in March because we count up to, but not including settlement. So we have the answer to our first question. 62 days of accrued interest are due to the seller. Now we need to turn that into dollars to answer our second question of how much accrued interest will be paid. 62 days divided by 365 days multiplied by $100 annual interest for a total of $16.98. $16.98 in accrued interest will be paid to the seller.